Hi, this is Rob Beardsley, and you're listening to the Passive Investor Show.
The views and opinions provided on this show are for informational purposes only and should not be misinterpreted as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, please go to passiveinvestorshow.com. Hey PI listeners, this is John Fortes. I'm making it a point to speak to as many investors as possible. My goal is to position myself to be a blessing to my network through conversation. How could one be a blessing through conversation? The easy answer is by listening. A simple conversation can open many opportunities and doors. I always ask myself this: what do I have to lose by having one more conversation? Going back to high school, I've connected friends and family in my network to one another, even if it didn't benefit me. And I continue those same principles and practices. Why? Because it's the right thing to do. If I can't help you, I probably know someone or something that can probably solve your problem. I'd love for you to become a part of that network. Go to www.johnfortes.com, create your investor profile, and schedule a call. How can I best serve you through conversation? In the words of Clarence the Angel from It's a Wonderful Life, no man is a failure who has friends.
And now, the Passive Investor Show. Here's your host, John Fortes.
Welcome, PI listeners, to the Passive Investor Show. I'm the Passive Investor Consultant, John Fortes, your host of the only ranked podcast for passive investors in multifamily syndications and real estate funds. Our goal and purpose of this show is to be a resource to investors and help them master their passive investments by beating inflation 1% at a time. Welcome back, ladies and gentlemen, to the Passive Investor Show. My guest today is Rob Beardsley. Rob Beardsley oversees acquisitions and capital markets for Lone Star Capital and has acquired over $100 million of multifamily real estate. He has evaluated thousands of opportunities using proprietary underwriting models and published the #1 book on multifamily underwriting, The Definitive Guide to Underwriting Multifamily Acquisitions. He has written over 50 articles about underwriting, deal structures, and capital markets, and hosts the Capital Spotlight podcast, which is focused on interviewing institutional investors. Welcome to the show, Rob.
Thanks for having me.
Hey, Rob, can you dive into your background just a little bit and just give us an idea of how you got to where you are?
Yeah, absolutely. So the short answer is about 3 years ago, my business partner and I, we founded Lone Star Capital to go on our own and own and operate multifamily in Texas. Prior to forming Lone Star, I was working in my family's real estate businesses in residential sales, development, construction, and rehab. But I knew that there was a better way, and multifamily being the superior route with better cash flow, better tax advantages, and a better creator of long-term wealth.
Awesome, man. That's the real quick version. I love it. I love it. So when you created Lone Star, when in that time frame did you start working with passive investors?
That's a good question. So we really started working with passive investors prior to forming Lone Star, similar to how a lot of people get started. And I think this is a great way to go, is to start raising capital prior to actually doing your own deals. And so that's what we did, or that's what I did on my family side prior to forming Lone Star. And that would give me the opportunity to learn about the business, also learn about, as you mentioned, dealing with investors, building relationships, and working that side of the business. So basically, when we started Lone Star, right off the bat, we were already had a little bit of experience and built-in relationships through previous networks. So we could just start raising capital right away, assuming we're finding good deals.
Now, there's probably a criteria factor when you're taking on new passive investors. What does that look like for you?
I'm really big on systems. And I think whenever I'm working on something or I'm building something, I'm always thinking with the end in mind, and I'm thinking about scalability. I want something to work not one time, but 100 times, 1,000 times. So definitely I have bought into building systems around investor relations and marketing. And so at this point, we've set up content and ways that we can go out and educate our existing investors as well as attract new investors. And then those investors can come to us and learn more about us either through the book I wrote, like you mentioned in the intro, or articles that I write, or the podcasts and things like that. And then from there, if they want to learn more, then we have forms that they can fill out to get in touch with us directly. That's really our investor onboarding process. In terms of qualifications, we don't spend a lot of time upfront really qualifying investors. We do want to know if they're accredited because that's a standard benchmark. However, in the past, we have worked with non-accredited investors, which has its pros and cons, but I think it's good if you can include more people rather than less.
Yeah, absolutely, absolutely. It all depends on the fund structure too. If it's a 506B or a 506C or any other type of those funds that meet with sophisticated rather than accredited, right? So it sounds like to me you guys are working more with accredited investors. So you're just verifying. What's the process like that? You're verifying accredited investors. Are you using a third party or are you using a form that the attorney provides that you give to their CPA? What's the practice you guys are doing?
So upfront, it's just they're self-verifying, but like you mentioned, as you get into the deal, if it's a 506C, for example, there's actually a verification process, a formal process that has to go on. And we previously have used just manual forms, but we're going to move into the direction of, again, scale and automation. And so we're going to work with a third party system or provider.
Awesome. Yeah. I mean, definitely if you can make it efficient and a better practice. There's some firms that I know that using third party scales where the investor will go ahead and pay the fee to the third party and then get self-accredited or accredited status or approved and then bring back to the investor, which is more efficient to me because of all the different timelines we're meeting on certain projects. Yeah, just keep that in mind. There's an option out there for that. I'm pretty sure you're aware of that. What is something you had to implement in your business as a result of working with passive investors?
I mean, it's definitely, we could talk more about the onboarding. And I think there's that is key, because if you're trying to build your business, and a big part of any business is your network, and if you aren't organized with that network, you can let a lot of things and people fall through the cracks. And that's what I really want to avoid. I hate wasting time, and I would hate to have a good phone conversation with somebody a year ago or 2 years ago, and then we never connect again, and they fall off the map for me. And so I don't want that to happen. So I think a few key things that have to be implemented in a good network system essentially are, first is the attraction of new people into your network. And the way that I think the best way to do that is content marketing. Seth Godin, a really famous marketer, said the only content left is content marketing. Everything else is dead. And so I love creating content, connecting with people, and it's a great way to actually educate people as well. So you're attracting like-minded individuals that resonate with your message. So that's number one. You need to attract people. And then the next thing is you need to actually nurture them and bring them in closer. And that's with ongoing contact. So that could be with a newsletter, or if they subscribe to your YouTube channel, or they subscribe to your podcast, for example. So if you have, like I said, you attract them, you bring them in, you have a good phone conversation, and then there's no follow-up, it's going to fall apart. So having that follow-up in a newsletter, I really love sending my newsletter. I just looked back at it yesterday. I've sent nearly 2 years worth of, or I'm sorry, nearly 3 years worth of newsletters by now, every single month. It's always super fun to write these newsletters and then send them out, and then kind of wait and see who's going to respond. And there's always kind of the usual suspects that always have something to say. I agree, I disagree, or somebody that you kind of forgot about, and then they come out of the woodwork and say, hey, thanks for the newsletter. We haven't caught up in a long time. Let's catch up. So I love that too, where it just kind of is a nice tickler to catch up with people.
Yeah, I really enjoyed the newsletter too. It's always a challenge to rebrand it, right? So kind of show a different look at it. I just went through that process this year. It's a fun process because it allows you to be creative. But I'm hitting on the newsletter because there's two schools of thought where if you have a certified accredited investors already listed, are you sending them a different newsletter than you are with the investors that haven't already reached out to you? Or are you sending everybody the same newsletter that basically everybody's getting?
Yeah. So my monthly newsletter, we call it the Lone Star Letter. Everybody gets that. That is for our broker contacts, for family and friends, for new investors, old investors, lenders. Everybody gets it, and I usually dive into some topic, something that's happening in the market, or some strategy that we're thinking about, and just providing an opinion piece, basically. So that's for everyone. But like you said, it's important to get smart with your different lists and make sure that you're sending the right content to the right people. So when we have a deal that we're going out and trying to market to investors, then that's going to our specific investor list. And then we have other lists of more like institutional type of investors that are more like joint venture partners. We have a specific list for them and want to communicate with them a little bit differently as well. So I think that's important as well to distinguish.
Yeah, I love how you're kind of segmenting everybody and siloing them in different categories. So thank you for sharing that. Now, I understand that you do the underwriting. Have other firms reached out to you to consult on your underwriting practices?
Yes. And it was something that we used to do. We still do it a little bit here and there for kind of relationship purposes, not really to make a buck. But yeah, we used to offer that somewhat like underwriting as a service, but we've really moved away from that just because it's very time consuming. It's not that it's a secret sauce or anything. Anybody can learn to underwrite, but it's just for us, our time is best spent focusing on our underwriting our own deals and building our own portfolio. So that's why we made that decision to move away from that.
What are some of the things you are looking out for during COVID as you are underwriting?
Yeah, well, the really hot topic during COVID as it relates to underwriting is really collections. You can underwrite all you want, and you can look at the T12, you can look at the rent roll, but collections is really what everyone wants to talk about. And what's really interesting, and this is going a bit deep for kind of the casual investor, but it's really interesting to realize the fact that collections don't immediately reflect on the P&L or the profit and loss statement or the trailing 12-month financial statement. And that's because when you have delinquent rent that is owed to you but not paid, that first sits on your balance sheet as an accounts receivable. And only once you write off that unreceived rent does it become bad debt or a write off and then show up on your income statement. When you're an accounting firm or you're doing your own internal accounting for a multifamily property, you can just hold delinquent rent on your balance sheet and not reflect it on the T12. And then at a later time, you can just boom, write it all off. So it's interesting when you're underwriting these deals right now. It's not enough just to look at the T12 and look at the bad debt and say, okay, well, there's the collections as they are, because that could not be potentially reflecting the full story. So it's good to you can either get a delinquency report or bank statements or something to get closer at the issue of actually rent that's coming into the bank.
And are you also underwriting no rent bumps going forward as as you're coming across opportunities right now? What does that look like for you right now? Because early during COVID, that was the conversation where if you're coming across opportunities, are you including rent bumps because everybody felt like there was a pause and a hiccup during COVID?
Right. Right. I think that's the smart thing to do. I think you can either look at it as a pause or as just a lengthening of your stabilization period. And that's initially the way that we were looking at it was, okay, take a pause, no rent growth for the first year, and then get to your business plan and then start growing rents organically, as well as through your value add. Now, some time has passed. I don't think we're definitely through it. I think there's still more uncertainty in the market. There's still pain to be felt due to this coronavirus recession. But the reality is deals are still very competitive. And if you want to even have a chance at winning and being the highest bidder and winning a deal, you need to have essentially aggressive underwriting that incorporates optimistic rent growth assumptions. So that's just the reality of the market. And if you want to fight it all you want, you'll never buy a deal. So we have to weigh the pros and cons and balance underwriting that lets us win deals, but protects us from downside risk.
As aside from multifamily acquisitions and putting them in front of investors when you come about them, are you doing any other opportunities such as funds or debt equity? What are you doing as another alternative to put in front of investors instead of just waiting for that sometimes elusive deal?
Yeah. And deals have been very elusive pre-COVID and especially post-COVID. A strategy that we launched in 2020, somewhat in response to COVID, but we were brainstorming the strategy even pre-COVID because it's a great all-weather strategy, is preferred equity. And preferred equity is a unique structured equity product that sits in the middle of the cap stack between senior debt and common equity. And so it has characteristics of both. Are similar to a lender because you are subordinating equity, but you're also equity because you are literally equity. So it's more of a situation where you get a fixed rate of return as equity rather than having unlimited potential upside. But in exchange for that, you get to sit preferential position in the equity position, only subordinate to the senior lender. So it's a good way to take advantage of a few things in the market right now. Lenders have pulled back on leverage in many cases. So if a lender before was lending at 80 or 75%, now they're lending at 75 or 70%. So they've pulled back by 5%, for example. And that creates the need for more equity. But sponsors don't want to have to necessarily go out and raise more equity and over equitize their deals. And so preferred equity can help fill that gap a bit. For us, we're happy to take less risk via structure and we'll sit lower in the stack. So for example, our preferred equity might only go up to 85% of cost rather than 100% of cost as traditional equity does. And so that 15% equity cushion essentially gets us into the deal at a discount. And for us, we're willing to take that downside risk in exchange for the unlimited upside of equity.
That sounds like a great investment product to put in front of investors. Now, are you raising that through a fund or are you raising that on investment by investment as they come?
Yeah, so far it's been on a deal by deal basis as we are growing the platform, but eventually we would like to turn that into a fund because it is really the best way to invest preferred equity is out of a fund because that pool of capital has diversification. So that what that allows you to do is you can invest in certain deals as preferred equity that has minimal cash flow but a lot of upside. And then also you can invest in deals that are really cash flow and you could get 12, 13% all as cash flow. And so if you could balance all that out, you'll get a nice blended return. And the other reason why a fund is great for preferred equity is the reality is preferred equity isn't always the first and best choice for sponsors. They may first want to explore their options for joint venture equity or raising syndication equity. And then often you see investors scramble and come to preferred equity as a choice of last resort, which is fine. But in the case of the preferred equity provider, that means you need to act quickly. They come to you and they want you to close in 2 weeks or 30 days, and you need to make a move. And so having that discretionary capital sitting in a fund allows you to take advantage of those unique situations.
Now, does that come in the form of similar to fund of funds? Is that the same kind of concept, or is that just a different model from a fund of fund concept?
It is a similar concept to a fund of funds because at the end of the day, we're pooling capital on behalf of investors into a managed entity, and that managed entity is making an investment, a structured investment, into a deal that we, as the manager of the entity, don't actually control day to day. We're leaving it up to the sponsor to actually manage the day to day, and we're relying on them to the extent. But we also have control rights and certain remedies like the right to force a sale or default interest and things that put us more looking like a lender essentially.
Also, yeah, I get it a little bit. I understand that concept now. Now, are you sitting as an LP or on the GP when you are coming in as preferred equity?
So you could look at it a few ways. I would say GP, but it's a GP within the managed entity. We don't take a GP of the deal.
Gotcha.
Essentially, just make some simple numbers. We may charge the deal as the preferred equity 14, 15%. And then the investors within the preferred equity position will make 12, 13%. And so we'll make that difference in a spread, right? So preferred equity, like most financial products, is a spread business. Lenders are making a spread and preferred equity is no different.
Awesome. Thank you for sharing, man. Because, we talk about fund of funds, we talk about just real estate funds, and now it's preferred equity funds. I really like that. Thank you. Rob, what is one piece of advice for PI listeners?
So one piece of advice for PI listeners, I would say, is to, just because you're a passive investor doesn't mean you can't underwrite. So I'm saying this a lot lately, and I love to say it, so I'll say it again. The biggest mistake passive investors make in regards to underwriting is not underwriting at all, right? You don't see too many passive investors actually doing their own underwriting. And I'm not asking them to become an expert and run the comps and do the whole thing, but just sanity checking the numbers. And if it's whether taking the numbers and plugging it into their own model that they're using, or just working within the sponsor's model and just tweaking with the numbers and just saying, hey, am I comfortable with these numbers as they are? Or what if I change a few of the numbers to reflect how I think maybe the deal will turn out? Am I still comfortable with the returns? I think that is really important for investors to do, and they'll learn a ton when they go through that process.
Well, thank you for sharing everything you brought to the table today. How can we stay in touch with you?
So if you want to learn more about us here at Lone Star, you can visit lscre.com. That stands for Lone Star Capital Real Estate.com. On our website, you can get a free copy of our underwriting model that we use every day to underwrite hundreds of deals per year. And if you're interested in connecting with us further, you can email me directly at rob@lonestarcapgroup.com.
And my favorite question, and it's probably pretty obvious because you probably already mentioned it with little clues here. What is the meaning behind your company name?
All right, well, we're really not creative guys. And so when we started our company, our focus was on Texas, and we didn't have necessarily any other name ideas. So my business partner thought, well, let's go with Lone Star Capital. It's worked so far, and it speaks to our focus in Texas.
Rob, thank you for coming on the show, man. We really appreciate your time.
Yeah, thank you.
Don't forget to download your free copy of the investment tracker. It allows you to track up to 5 investments, compare sponsors, markets, and most importantly, projected versus actual returns. To get your copy, go to www.projectedreturns.com. PI listeners, thank you for listening. As always, we hope this was the best resource for your investment strategy, but also the best use of your time. Remember, if this episode helps you, you can help us by leaving a review on iTunes. I hope you feel compelled enough to share it with someone you think this would resonate with as well. As much as it pains us to leave you, but you know what time it is. Time to go put this into practice. Till the next time we meet, happy investing. PI listeners, I'm grateful for your time and I appreciate you for listening. It would mean the world to me if you went to iTunes and left a rating and written review. Let me know how you feel about the show. It really makes a big difference with getting the podcast out there. Don't forget about our Facebook group, where all of our guests are members of. I'll be there to answer any of your questions, or even questions you might have for future guests. Subscribe so you can get the latest episodes and our fan favorite quick hitters. Finally, I want to keep you updated, so head over to johnfortes.com and sign up for the newsletter. If you're interested in partnering with me, sign up on the contact page so you can talk to me directly. I look forward to connecting with you. Happy investing.